John Bogle was born in 1929 in Montclair, New Jersey, the same year the stock market collapsed and the Great Depression began. His family had once had real standing in their community. They lost nearly all of it in the crash that followed. By the time Bogle was 10 years old, he was already working, delivering newspapers, then waiting tables, helping keep the household afloat during years when almost nobody around him had much room to spare. Decades later, reflecting on that period, he'd say simply that you learn at a very young age that you'd better roll up your sleeves. And that if you never learn that lesson, you're at a real disadvantage for the rest of your life. He earned a scholarship to a prep school on the Jersey Shore, then another to Princeton University. He waited tables and worked the ticket office at Princeton's athletic department to help cover the rest. He wasn't born into finance. He worked his way into it, one modest job at a time. In 1951, as a senior at Princeton, Bogle wrote his undergraduate thesis on the mutual fund industry. Buried inside it was an observation that would eventually define the rest of his life. Fees were quietly destroying investor returns. Fund managers charged substantial fees to actively pick stocks, trying to beat the market. And Bogle had noticed something uncomfortable hiding in the data. Over long periods, most of those actively managed funds didn't actually beat the market at all. Investors were paying a premium for outperformance that, on average, simply wasn't there. After graduating, Bogle was hired by the founder of Wellington Management, one of the country's oldest mutual fund companies, and spent the next 2 decades rising through its ranks, eventually becoming its chairman. But in the early 1970s, he pushed through a merger meant to modernize the firm, combining Wellington with a newer, more aggressive investment partnership. It backfired badly. The partnership soured, performance suffered, and in 1974, the very board Bogle had once led voted to remove him from the company he'd spent his entire career building. He was 45 years old, fired from the firm that had defined his professional life. Bogle would later describe the experience, half joking, as being fired with enthusiasm. His own blunt way of admitting just how humbling it actually was. There was something else running quietly underneath all of this, something that makes the rest of the story land differently once you know it. Bogle had suffered his first heart attack at age 31, years before any of this happened. He would go on to have several more over the following decades. The man who was about to spend the next 20 years fighting an entire industry to prove a single idea was doing it while living the whole time, with a heart condition serious enough that doctors weren't certain how long he actually had. He didn't retreat after being pushed out of Wellington. He returned to that old Princeton thesis, now with a much bolder idea attached to it. What if, instead of paying expensive fund managers to try, and mostly fail, to beat the market, you simply built a fund that did nothing clever at all? A fund that didn't pick stocks, didn't time the market, didn't try to outsmart anyone. It would just buy a small slice of every company in a major market index, hold it, and charge almost nothing to do it. He wasn't entirely alone in the theory. A few years earlier, in 1973, a Princeton economics professor named Burton Malkiel had written that what investors really needed was a low-fee fund that simply bought the broad market and didn't trade. Bluntly noting that fund managers themselves kept insisting you can't buy the averages, and that it was about time ordinary people actually could. The academic case existed. Almost nobody in the industry had acted on it. In 1974, Bogle founded a new company to build this idea into something real: Vanguard. 2 years later, in August of 1976, he launched it. A fund called First Index Investment Trust, hoping to raise somewhere between $50 and $150 million from investors to get it off the ground. It raised just over $11 million. Bogle himself later called it, in his characteristically blunt way, an abject failure. Wall Street didn't just shrug it off. Competitors mocked it outright. The fund earned a nickname that would follow Bogle around for years: Bogle's Folly. One investment industry journal shortly after launch described the reaction bluntly. Some called index funds a cop-out, a passing fad. Only a small minority believed they represented anything resembling the future. The core objection was almost emotional. Why would any serious investor deliberately accept merely average returns when skilled professionals were right there promising to beat the market for you? Settling for average sounded to most people in the industry like giving up before you'd even tried. Bogle's answer, quiet, consistent, almost stubborn in its simplicity, was that average, once you accounted for the substantial fees actively managed funds charge, usually beat what investors were actually receiving in the first place. Nobody wanted to hear it. Growth was brutally slow. By 1982, 6 years after launch, the fund had grown to roughly $100 million, respectable on its own, but still a tiny, mocked corner of a massive industry. It took until 1988, 12 full years after launch, to finally cross $1 billion, a milestone that only sounds impressive until you realize how long it actually took to get there. Competing companies weren't racing to copy the idea either. A second index fund from Wells Fargo didn't even enter the market until 1984, 8 years after Bogle's. Even by 1990, nearly a decade and a half after the concept launched, there were still only about 5 index funds in existence, holding roughly $4.5 billion combined, barely 2% of all mutual fund assets in the country at the time. Imagine spending 15 years building something that survives but doesn't thrive. Mocked the entire time by an industry that considered your life's work a well-meaning joke, all while carrying a heart condition serious enough that you genuinely didn't know how many of those years you'd actually get. Here's where the story turns. Slowly, and then unmistakably, the data started speaking for itself. Year after year, decade after decade, a consistent and uncomfortable pattern kept showing up in the numbers. When researchers compared actively managed funds against simple, low-cost index funds, the index funds kept winning. Not every single year for every single fund, but consistently over any long stretch of time across nearly every category studied. Domestic stocks, international stocks, bonds. Low-cost indexing came out ahead more often than not. Perhaps the single clearest proof of this came in 2007, when the legendary investor Warren Buffett made a public bet, $500,000, later matched by a hedge fund manager named Ted Sides, with proceeds going to charity either way. Buffett's wager was simple. Over the following 10 years, a plain, low-cost S&P 500 index fund would outperform a hand-picked group of expensive hedge funds once all their fees were accounted for. Sides accepted and selected 5 funds run by some of the sharpest, most highly paid minds on Wall Street. Over that decade, Buffett's simple index fund gained roughly 126%. Sides' hand-picked hedge funds, on average, gained a small fraction of that. It wasn't close. Some of the best-paid investment professionals in the world, actively trying to beat the market, were outperformed by an index fund that did nothing but quietly hold the whole market and get out of its own way. The reason wasn't some hidden genius buried in Bogle's specific fund design. It was almost embarrassingly mathematical. Every dollar an actively managed fund charges in fees is a dollar that has to be earned back through market-beating performance just to break even with a cheaper alternative. Do that every year for 20 or 30 years, and the fee gap alone compounds into an enormous difference, even before accounting for the fact that most active managers over that same stretch failed to consistently beat the market at all. There was also a quieter structural reason Vanguard could keep charging so little in the first place. Bogle set the company up in an unusual way. Instead of Vanguard being owned by outside shareholders looking to maximize profit from the fees they charged investors, Vanguard was structured to be owned by its own funds, which were, in turn, owned by the everyday investors putting money into them. There was no outside owner demanding higher profits squeezed out of higher fees. The people paying the fees and the people who, in effect, owned the company were the same people. That structure alone made it far easier for Vanguard to keep costs low permanently, not just as a temporary promotion. In 1996, at 66 years old, Bogle's heart condition finally caught up with him seriously enough that he needed a transplant. He got one, and it worked. 20 years later, his family threw an actual birthday party for his new heart. And by his own account, he spent every one of those extra years determined to make them count. By the time Bogle passed away in 2019 at the age of 89, the fund he'd launched with just over 11 million mock dollars back in 1976 had grown into one holding several $100 billion on its own. One piece of a much larger indexing movement his original idea had sparked. Assets across all index mutual funds by then were measured in the trillions. Warren Buffett himself wrote publicly that if there were ever a statue built to honor the person who'd done the most for ordinary American investors, Bogle would be the obvious, unanimous choice. The man who was fired in disgrace, mocked for over a decade by an entire industry, who built his life's work while living with a heart condition that nearly killed him more than once, ended up quietly reshaping how millions of ordinary people invest their money all over the world. So here's what actually matters for you, walking away from this, because unlike a lot of financial history, this one comes with something genuinely actionable. Bogle drew a sharp line between two very different things people often confuse: investing and speculating. Investing, in his view, means putting money into something for the long term, expecting it to grow steadily alongside the broader economy, accepting some short-term ups and downs along the way. Speculating means trying to make fast money in a short window, essentially betting on being right about something nobody can reliably predict. Most of the financial stress people carry, in Bogle's view, comes from accidentally speculating while believing they're investing. The core idea he spent his life defending translates into something almost anyone can apply, starting today. For most people, trying to pick winning individual stocks or trying to find a fund manager who can reliably beat the market year after year is a much harder game to win consistently than it appears. And even in years it works, fees quietly erode the advantage over time. A simple, low-cost index fund, one that holds a broad slice of the entire market instead of trying to outsmart it, has, over long periods, outperformed the majority of expensive, actively managed alternatives. Practically, here's what that means when you're actually looking at investment options. Pay attention to something called the expense ratio. The annual fee a fund charges, expressed as a small percentage of your investment. A broad market index fund typically charges a small fraction of what an actively managed fund charges for a similar category. That difference sounds tiny in any single year. Compounded over 20 or 30 years, it becomes one of the largest factors separating a comfortable retirement from a stressful one, often larger than which specific stocks anyone happened to pick. You're not trying to be the smartest person in the market. You're trying to own a small piece of the whole thing cheaply and let time do the rest of the work, the same bet Bogle placed on himself decades before anyone else was willing to believe in it.